A couple of weeks ago, the crypto market saw its biggest liquidation event of the year, with over $1.8 billion wiped out in less than 24 hours. What's crazy is that there wasn't really a catalyst for this, and the stock market actually rallied at the same time. When this happens, it's typically a sign of one thing: crypto market manipulation. That's why today, we're telling you everything about crypto market manipulation, including what happened with the recent liquidations, why such manipulation happens, who's doing it, and how you can outsmart even the smartest money. My name is Louis. Stay tuned. Before we begin though, nothing in this video is financial advice. It's for educational purposes only to inform you about manipulation in the crypto market. If you find content like this helpful, then help us out by smashing that like button. Now, crypto is well known for being a volatile asset class. Even large cap cryptos can see double-digit percentage swings in either direction. But more often than not, these large moves aren't caused by any actual selling, but rather by liquidated positions. This is precisely what happened on the 22nd of September, when over $1.8 billion in levered crypto positions were wiped out, triggering the biggest liquidation event of 2025 so far. For those unfamiliar, leverage means trading with borrowed capital. It involves depositing crypto into an exchange as collateral and the exchange lending you extra to trade with. For example, $1,000 at 10x leverage lets you trade with $10,000. If the price rises 10%, you've made $1,000, doubling your initial investment. But if the price falls 10%, that $1,000 disappears. This is called a liquidation, and it could suddenly push a crypto's price up or down depending on whether longs or shorts are wiped out. For those unfamiliar, going long means betting prices will rise, while going short means they're betting that they will fall. When shorts are liquidated, traders are forced to buy, pushing the prices up. When longs are liquidated, traders must sell, driving the prices down. This is often the reason behind those big red or green candles that seem to appear out of nowhere. And once they start, one liquidation can trigger another, creating a cascade until there's no more levered positions left to flush out. And by the way, if you want to learn more about liquidations in greater detail, then we recommend that you check out our most recent video on that right over here. So, leverage plays a big role in crypto market manipulation. That's because whales can often see where most traders will be liquidated or squeezed, and they will try to push prices in that direction. Normally, this happens naturally, as a result of some bullish or bearish catalyst, but sometimes it happens for no apparent reason at all. This is a big deal, because when the market isn't driven by major events, it usually means someone is pulling the strings. In other words, it's evidence that crypto prices are being deliberately pushed around by whales. Given that the crypto market is a multi-trillion-dollar powerhouse, you might wonder how whales can cause such disruption. The answer is market liquidity, or rather, the lack thereof. As macro analyst Andreas Steno explained in a recent Real Vision podcast, liquidity is at its thinnest over the weekend, and there's a quote, liquidity air pocket between Sunday night and Monday morning, creating the perfect conditions for market manipulation. Lo and behold, that's exactly when the massive liquidations happened a couple of weeks ago. Now, market manipulation is nothing new, and it certainly isn't exclusive to crypto. Every financial market is subject to manipulation from bad actors, including the stock market and the foreign exchange market. If you watched our video on how the crypto market is rigged, you'll recall that we highlighted a 2019 headline revealing that 6 major banks had effectively formed a foreign exchange cartel. Between 2007 and 2013, they shared plans and sensitive information about orders, prices, and trading activities in the FX market. You could learn more about that by watching the video right over here. Of course, this is just one of many examples, but it's significant because equities and forex markets are heavily regulated, and yet whales still find ways to manipulate them. Logically, this makes less regulated markets like crypto even more vulnerable to manipulation. But what tactics are these manipulators using, I hear you ask? Well, great question. They actually have several tools at their disposal. The most commonly used is wash trading. This is when whales repeatedly buy and sell the same asset to create fake volume, giving the illusion of high demand or liquidity. FTX is an infamous example of this. An investigation by the SEC found that FTX manipulated its FTT token by, quote, purchasing large quantities on the open market to prop up its price. Another market manipulation tactic is spoofing and layering, where whales place large buy and sell orders without intending to execute, creating a false sense of market sentiment before canceling these orders to manipulate prices. Sometimes these orders target specific prices to create psychological barriers that influence trading behavior. Despite being illegal in most jurisdictions, crypto spoofing remains a problem to this day. For instance, in April of this year, a $212 million BTC sell order was placed on Binance at $85,600, above the current market price at the time. The order vanished almost immediately, unsettling the market and triggering sudden volatility by distorting sentiment and liquidity. And if these bad actors are feeling particularly tech-savvy, they might even tamper with the data oracles that DeFi protocols rely on for token prices, distorting values used for loans, collateral assessments, and liquidations. A prime example of this is with Mango Markets, a Solana-based DEX that suffered an exploit in October of 2022. Basically, an attacker used $10 million in USDC to artificially inflate the price of Mango Markets' native MNGO token by trading across multiple DeFi platforms simultaneously. This inflated value allowed massive borrowing against the manipulated collateral, ultimately draining over $110 million before the price crashed back down. Now, I know what you're thinking. This sounds a little scary. How can I avoid it? It's actually pretty simple. Use the right exchange. And you could find links to some of the best ones on the Coin Bureau's deals page. There, you'll also find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks up to 75% on top crypto exchanges. Best of all, none of these exchanges engage in market manipulation. All you need to do right now is hit the link in the description or scan this QR code. Once you get on the deals page, you'll see all of our offers across a range of exchange partners. Click one of the Sign Up Now buttons, and that should take you right to the deal. These deals won't be around forever though, so take advantage of them while you still can using the link in the description below or by scanning the QR code on the screen. By now, it's clear that market manipulators exploit everyday retail investors like you and me, siphoning as much profit as they can. But why do these tactics work? After all, crypto is an open market, and we have all the same tools, right? Well, yes, and that is sort of the problem. You see, most retail investors are analyzing the same data points, the same technical indicators, the same support and resistance levels, the same candlestick patterns. You get the idea. But here's the thing. This analysis is driven by human emotion. And in trading, two emotions dominate above all: fear and greed. Since everyone uses the same data, it's no surprise that many traders spot the same support and resistance levels. Some traders try to outsmart others by trading just above support or just below resistance, but ultimately, retail activity is highly predictable and therefore easy to exploit. Larger traders, on the other hand, study retail behavior and pour billions into algorithmic trading systems